Casey Johnson in Professor Pierce's accounting class. For part 1, in logging the journal entries, the business is getting started, so funds had to be exchanged for common stock in the business. So I debited cash, computer equipment, and office equipment to increase them as assets, and I credited common stock, which increased it as equity. You can tell that cash, computer equipment, and office equipment are debits because they are not indented, and their related amounts are in the debit column, which is always on the left, and should be listed first in a journal entry. Common stock is easy to spot as a credit because it is indented and the amount is in the column on the right, which is the credit column. And credits are always listed after debits. When the company paid cash for 4 months' rent, it didn't get recorded right away as rent expense. Instead, I debited prepaid rent and credited cash because this payment covers future months, not just October. This was similar for paying for a year of insurance. I debited prepaid insurance and credited cash. When the company performed services and billed Easy Leasing on October 6th, I debited accounts receivable because the company is owed money, and credited computer services revenue because the revenue is recorded when it's earned. On October 8th, the company paid for supplies it had already purchased on credit, so I debited accounts payable to reduce the liability, and credited cash because cash decreases. There was no journal entry on October 10th because no actual transaction took place. Hiring someone does not affect the accounting equation. When Easy Leasing paid cash, I debited cash and credited accounts receivable. This reduced the amount owed and increased cash in our business. When we had to pay for equipment and repair on October 17th, I debited repair expenses because this was a normal repair for maintenance instead of improving or extending its life, and credited cash. As additional expenses were made for cash, I debited the expense account and credited cash to reflect the increase in expense and decrease in assets for the business. Paying dividends are where I debited the dividends and credited cash because cash was paid to stockholders. I also remember that dividends reduce retained earnings later during closing. November transactions followed the same concept. I will note that on November 25th, they were sending another bill to IFM Company, and so that did not require a journal entry. Okay, now it's problem 2. Now we're 2 months into the business, and many entries are similar to what we did in October. Some different journal entries were on December 14th, where Business Solutions bid of $7,900 had been accepted, and we paid $1,500 cash advance. I was a little confused at first, but then I realized that the company had yet actually performed the services or received the whole amount, so I recorded a liability instead of revenue. And debited cash for $1,500 and credited unearned computer services revenue for the same amount. For purchases on credit, like supplies purchased on December 15th, I debited the correct supply account and credited accounts payable because supplies are an asset and it was purchased on credit, so accounts payable increases. For here, on December 16th, there was no journal entries because it was a reminder was sent to Gomez Company, so there was nothing to put. And then this one is adjusting entries. Adjusting entries are needed to make sure revenues and expenses are recorded in the correct accounting period under the accrual basis of accounting. These adjustments account for supplies used, prepaid insurance prepaid expenses that have been expired, such as insurance, and accrued wages and depreciation. For the first, I adjusted computer supplies. The trial balance showed a supply balance of $2,545 as of December 31st. The inventory shows $670 still available. And then on December 15th, there was a purchase of $1,800 of computer supplies, which increased the supply balance. So to figure out the amount used during the period, I took $2,545 and added $1,800, and then minus the $670, and then that equaled the $3,675. To record this, I debited computer supplies expenses, and then I credited computer supplies for that amount. This makes sure that only the $670 supplies still on hand remain as an asset, and the amount used is recorded as an expense. Next, I adjusted prepaid insurance. The prepaid insurance is $2,100 for a 12-month policy. 3 months had expired, so $2,100 divided by 3 is $175 per month. And then I did $175 times 3, which is $525 over here. And so I recorded the $525 as insurance expense for a debit, and then credited prepaid insurance for $525 as well to balance it out. To calculate the accrued wages for Lynn Addy, I calculated 4 days times $125 per day, which equaled $500. She worked in December but wasn't paid, so I recorded both the expense and the liability by debiting wages expense and crediting wages payable for $500 both. The computer supply system on October 1st with a 4-year life. To figure the depreciation, I took the purchase price of $23,600 and then I divided it by 4 years, which was $5,900 per year. And then I divided 5,900 by 12, which came out to be $491.67 per month. To calculate for the 3 months it was used from October through December, I did 491 times 3, which came out to be $1,475. To record this, I debited depreciation expense computer equipment and credited accumulated depreciation computer equipment. Accumulated depreciation increases because it's a contra asset account. And then this next one, recording the office equipment depreciation was done the same way. Cost of $8,800 divided by 5 years extended life equals $1,760, and then I divided it by 12 months for the 12 months in a year, or by 12 for the 12 months in a year, and that equaled $146.67 per month. For the 3 months of October through December it was used, this equaled $440, and the entry I debited depreciation expense office equipment and credited accumulated depreciation office equipment for the $440. And then the last adjustment was for prepaid rent. The balance was $3,020 for 4 months, and 3 of those months were expired. So $3,020 divided by 4 equals $755 per month, and then I did 755 times 3, which equaled this 2,265. And so I debited rent expense and credited prepaid rent. Okay, now this is the income statement. After recording all transactions and adjusting entries, the financial statement, we're prepared to summarize the company's performance. The income statement reports the company's revenues and expenses for the 3-month period and shows whether the company earned a profit or not. And they did earn a profit because it's net income. And then this is the revenue and expenses together. Overall, the income statement shows if the business is operating successfully and helps evaluate overall performance using the revenue from the adjusted trial balance and subtracting all expenses whose amounts are also found on the adjusted trial balance. I found that the company had a net income that I put down here. And then the statement of retained earnings shows how net income affects the company's equity. Taking beginning retained earnings from October 1st, adding the net income from the previous slide, and subtracting the dividends to pay owners. The ending retained earning of December 31st balance shows the overall profit retained in the business. Okay. Looking at the balance sheet, you see as of December 31st, the company's assets, what it owes, such as cash, accounts payable, supplies, and like all those, and then the liabilities down here, what the company owes, such as accounts payable, wages payable, and and the equity shows, and then the retained earnings in common stock in the equity. You can see I did forget to label the totals for my current assets up here, and then my plant assets and total assets down here, and then my total liabilities. I don't know how I missed that. I just did on accident. This shows overall whether the company has enough assets to cover its obligations and shows the company's financial stability and liquidity. After preparing the financial statements, the final step in the accounting cycle is recording closing entries. This is all these. This transfers the balance of temporary accounts and permanent accounts so that the company can begin the next accounting period with zero balances in revenue, expenses, and dividend accounts. First, all revenue accounts are closed. Computer services revenue was debited to bring it to zero. Then the total revenue is credited to income summary. Then all expenses accounts are closed. We needed to debit the income summary and credit all expenses accounts to close them out, all of these. Since we have a credit balance in our income summary, which means net income, to close it, income summary is debited, and then retained earnings is credited. This transfers the company's profit into retained earnings. And then finally, the dividends are closed to retained earnings, debited retained earnings, and credited dividends. Okay. The post-closing trial balance is the final step. It's to verify that the company's permanent accounts are in balance and ready for the next accounting period. It includes only permanent accounts such as assets, liabilities, common stock, retained earnings. All the temporary accounts we just closed out are not included. This step makes sure that total debits equal total credits down here after the closing process, and ensures the accounting equation is still in balance. It also verifies that all temporary accounts were properly closed to retained earnings. It also establishes the beginning balances for the next accounting period. Okay, and that's it. Thank you.